So my name is Kristen Fanarakis, and I work with Professor Russ Warners, the director of the Center for Financial Policy. And the CFP is the leading center that regularly brings together individuals from the regulatory, academic, and financial industry to discuss the most pressing issues affecting the financial markets. Over the past year, we've hosted two separate series of events on financial stability analysis and data, and then also on ESG, which has been heavily focused on climate change, called the Second Objective Function. Today's event combines those two series. You can find more information about both of those series in links on the chat, along with other CFP events. The University of Maryland is also starting a broader initiative on climate finance, so please watch your email for future information. By attending today's event, you will be added to the CFP's mailing list. I'm pleased to introduce today's moderator, Arthur Small, who is part of the organizing committee that drives our financial stability analysis and data series. He is a principal scientist in the Weldon Cooper Center for Public Service at the University of Virginia. Art, I'll turn it over to you.
That we have here today. So I'm going to start with a little context. When I was first finishing my PhD and I was on the academic job market, having finished some work in environmental economics, I was interviewing for a job at Columbia Business School. And the head of the finance and economics division looked across the desk at me rather disapprovingly, and he explained to me, listen, our students aren't here to save the world. Our students are here to get an edge on Wall Street. He was just completely dismissive of the notion that the environment had anything to do with the financial system. And so fast forward about a couple decades, and this is what we have as of last Thursday. An executive order from the President of the United States telling all of the units of the US federal government that the climate is changing and there are financial shocks that are going to be happening as a result of this, and that we need all hands on deck to get ready for this eventuality. And this is now the context in which we are operating. As the head of the one of the officials at the White House explained, the financial system has developed in a context of a stable climate, and that is what and we've come to expect that and build our institutions on top of that. That assumption can no longer be sustained, and so we need to think about rethink many of the ways that we do that we handle financial risk analysis. What we're going to focus on today, there's a long list of really important initiatives in this executive order, which I recommend you look up. But what we're going to focus on today is a piece of it that focuses on the stability of the financial system overall. And the question is if climate change is going to create a less stable physical environment, is there a possibility of actual instability hitting the financial system itself? And so for this, we're going to welcome several speakers who have thought a lot about these issues from various perspectives, and pleased to welcome in first Alessandro Cocco from the Federal Reserve Bank of Chicago, Houston Baltzell from Helios Exchange, and Julie Pullen from Jupiter Intelligence. So we'll start off with Alessandro. He's Vice President of Financial Markets Group in the Federal Reserve Bank of Chicago. Alessandro will discuss how entities like the Fed and its European counterparts are starting to look at climate risks, and will offer us a conceptual framework for addressing the distinctive challenge of integrating climate risk analysis with financial analysis. So pleased to welcome Alessandro. Please take it away.
Thank you very much, Arthur, for the very kind introduction. Can you hear me okay?
Yes, we can.
Oh, great. So as you noted, I work in the research department at the Federal Reserve Bank of Chicago, and I'm responsible for the Financial Markets Group, or FMG. in my team, we analyze policy issues in financial markets and infrastructures, and we look at that from multiple perspectives, such as legal, risk management, technology. And I wanted to stress my comments are from a research point of view, not from a supervisory or regulatory point of view. And also, before I go any further, I have to mention that the views expressed here are my own and not those of the Federal Reserve Bank of Chicago or the Federal Reserve System. So having said that, so access to good data is essential for the management of climate change risk. One example is this: the CFTC climate change report that was issued last year has called attention on the importance of decision useful climate risk disclosures. So the work that needs to be done to get to disclosures that are in fact useful for investment managers to make investment decisions is kind of what I'd like to go through today. All of this is kind of background to ideally getting to this concept of decision useful disclosures. Speaking from a research perspective, I also note that our efforts, as you mentioned, by the European Central Bank, by the Fed, to establish a supervisory approach to climate change risk as a systemic risk in the context of banking supervision. And Arthur, I'd like to go in a little bit more detail on the executive order that was issued on May 20th, because I do think it's relevant to what we're talking about here, of course, as you already indicated. So just very briefly, I wanted to mention that the order does a few things. It orders the Secretary of the Treasury, together with other senior officials, to develop within 120 days of the date of the order, which was again May 20th, a government-wide strategy. And the strategy has to address the measurement, assessment, mitigation, and disclosure of climate-related financial risk to the federal government. The other thing that the order does is that it directs the Secretary of the Treasury, Yellen, as the chair of the Financial Stability Oversight Council, FSOC, to engage with FSOC members, so essentially every other regulatory agency. And what are they required to do? They have to assess the climate-related financial risk to the financial stability of the federal government and the stability of the US financial system. And they have to facilitate the sharing of climate-related financial risk data and information among FSOC member agencies and issue a report to the president. This one is due within 180 days of the date of the order. The report has to address a number of matters, including the necessity of any actions to enhance climate-related disclosures and any current approaches to incorporating the consideration of climate-related financial risk into their regulatory and supervisory activities. In addition, given that we're particularly focused on data in today, so the order also provides the Secretary of the Treasury shall direct the Office of Financial Research to assist Treasury and FSOC in assessing and identifying climate-related financial risk to financial stability, including the collection of data as appropriate and the development of research. So that's kind of the framework that you also mentioned earlier on. And I wanted to note that in March of this year, the SEC, with Acting Chair Alison Heron-Lee, announced the creation of a climate and ESG task force. The SEC had previously issued an interpretive release that provided guidance to issuers on how existing disclosure requirements apply to climate change matters. That release was from 2010, so clearly a lot has changed since 2010. And then earlier this year, the Federal Reserve Board announced the creation of two committees. One is microprudential, the other one is macroprudential. So the FSCC, Financial Stability Climate Committee, will focus on the macroprudential aspects of climate change risk, such as climate-related economic shocks, and how climate change could amplify these shocks and cause broader knock-on effects. And then the microprudential committee is called Supervision Climate Committee. So again, we'll focus on work to ensure the safety and soundness of financial institutions. Now, looking at Europe, in November of 2020, the ECB, European Central Bank, published a final version of its guide on climate-related and environmental risks for banks. So the ECB has a plan of action that will be articulated over the coming years. And European banks are expected to perform a self-assessment on ECB expectations now in early 2021. And then the ECB will review the bank's best practices in 2022, and it will conduct supervisory stress tests in 2022 that will focus on climate-related risks. So now, if we look to the private sector in the United States, clearinghouses and asset managers have started to consider the challenges that are posed by climate change, but we note that a methodology for assessing climate change risk has not emerged at this time. So in Europe, an assessment of euro area institutions by the European Central Bank shows that firms have yet to develop a comprehensive risk management approach. So taking all of this into account, there's regulatory focus efforts by the private sector, but we don't have, as of now, a comprehensive risk management approach to climate change risk. And so on this topic, in my group, the Financial Markets Group at the Federal Reserve Bank of Chicago, we published a paper. The paper is titled "A New Framework for Assessing Climate Change Risk in Financial Markets." And in the paper, we look at a new framework for research in this area, and we merge the climate change risk categories of physical risk, transition risk, and liability risk. We merge those with the risk categories that are commonly assessed in the financial markets. So market risk, credit risk, liquidity risk, and operational risk. And then we take into account market structure and market regulation. But there's still quite a lot of work to do on this topic. I wanted to note that the way that clearinghouses think in terms of risk management, they are typically taking into account different risk categories in conducting their stress tests. And so they look at historic risk. Historic has to do with replaying past events today. Then they look at hypothetical risk. So that takes into account events that have not happened but could happen. And then theoretical. So statistical mathematical models that are applied to gauge potential losses. And a classic example of theoretical stress is modeling unobserved changes in correlations. And so that would be, the idea would be, how do you take these categories to see where climate change risk can fit in, or whether we need to think of new ways of addressing climate change risk. And of course, climate change risk evolves in a nonlinear fashion. It can be small today, big tomorrow, and then small again. And the future may differ fundamentally from the past. And in addition, we have not only these large catastrophic events, but also the slow and steady incremental changes such as sea level rise. Accurate data is now a key component of assessing the potential impact of climate change on systemic stability. And we're still in the early stages of conducting our research on this important area, but our research is ongoing. Please watch this space, and feel free to reach out to us with research ideas or collaborations or any ways to shed light on this important issue. Arthur, back to you.
There's so much to cover. Excellent. This is so much to cover here. I have tons of questions, and I hope and expect that others will as well. I'm going to encourage, we're going to hold the questions until the end of the, until we've heard from the three panelists, and then we'll have some question and answer amongst ourselves. And we invite and encourage those who have questions to please post them in the Q&A section of the webinar. So we're going to move on now to talk more about how we can address bringing some of these data and analytics to the questions of measuring and understanding climate risk with our next speaker. Houston Baltzell is a figure well known in the domains of environmental risk and finance. Houston currently is president and chief operating officer of Helios Exchange, and more to the point for us today, is one of the driving forces behind OS Climate, which is an open source platform for bringing data and analytics to the financial analysis of climate risks, which is organized under the Linux Foundation. Houston will introduce the OS Climate platform and offer thoughts on what it does and does not, perhaps yet, offer as a tool for analysis of systemic financial risks. Houston.
Thanks, Art. I'm sharing my screen. Okay, can you see that? Okay. Well, thanks very much to Art for arranging this, and to everyone for joining today. As Art said, I'm president of Helios Exchange. There we are focused on energy efficiency in buildings and reducing carbon emissions. But really I'm here in my capacity as product lead at Open Source Climate, which is a project under the Linux Foundation. That's a large foundation which has maybe 200 million in revenue that has many, many projects that focus on expanding the use of open source projects in code and technology. There we go. So the problem that we have talked about that actually Alessandro outlined is that to make a transition to meet Paris goals and to get to our clean energy future, there's a gap of about 1.2 trillion annually. So we need a way to, in a large scale, we have a large scale reallocation of capital to accomplish that. Institutional investors need to take the lead in that. And a main barrier in that process is lack of data and analytics that is agreed to and trustworthy, et cetera. And it's also, this problem is compounded by lack of standardization, chaotic marketplace, private and nonprofit and other providers in many different frameworks. So the need that we see is to make fast progress in this. And to do that, we can have a shared platform to rapidly develop solutions, to basically connect the best science, climate science that's out there to the financial markets in ways that the financial markets can absorb and in ways that can be built into risk models. So we need to make this easy to access and use, and we need to facilitate many parties joining so we can all build what we call the pre-competitive layer, which is the basic, more solid data and analytics that will help the market function and develop faster. So the solution that we have built, or are building, is an open source community under the Linux Foundation, which is available to everyone. It is now, currently we have members, so it's a member supported organization, but the members, they contribute both funding and code and FTEs and whatever else they can, but all of the results are open source. So in that, this is indicative of the different groups involved. We have a number of big financial players. So Allianz, and the person at Allianz who's our kind of lead is actually the head of risk, Udo Risa. We have Federated Hermes, Goldman Sachs, BNP Paribas joined. We actually just have KPMG just joined, and we're getting another big four accounting firm. And they are all very interested in what's going on in Europe and helping a lot of clients trying to deal with those risk management, and scenario planning that Alessandro mentioned. On the tech side, we've got Amazon and Microsoft, and now we have Red Hat, who's going to actually be building this platform leading up to a COP26, sort of launch of the Alpha project. And then on the data side, we have Standard & Poor's and LSEG. And then we have others like the Net Zero Asset Owner Alliance and Ortec Finance. So this shows that there are a number of different players who might have competitive, be competing against each other in a number of ways, but are focused on trying to build this platform. So what do we see as, what is it that we're building to try to get this data together and into the financial system? This is a basic functional schematic. We're building a data commons where we're bringing data in from various places, organizing it, and then putting it through to go out. And then we are building various models and analytics and platforms to distribute that data. Here's a more complicated diagram, but I'll show you where we are right now, which will lead into Julie's conversations. So in this data commons, we are bringing in various types of data. So that might be Environmental Protection Agency data, or data from many number of great NGOs. So we're doing a utility sector pilot right now. So we have data coming in from World Resources Institute, Rocky Mountain Institute, Ceres, Sierra Club, others, as well as EPA. And we also are bringing in, we're building a corporate data collector as well. which will make it easier for companies to directly provide data into this data commons. Inside the data commons, the data needs to be tagged and organized. It needs to be put in a factor scheme so we know what all the data points are. We need to identify companies so that we can ultimately have them part of a portfolio. And then we bring in other types of data. Down here, we're bringing in physical risk data, which Julie will talk about from Jupiter Intelligence. So that way we'll be able to map asset information that's coming in from various sources, map that data to their ultimate parents so that we can then map them through to securities and to risk models, et cetera. And we can also do physical risk by mapping facilities to lat long and then showing them in various climate scenarios. So really, this is all of the plumbing that we need to do to try to get the system and the data fully connected from excellent climate sources through processed, put into the right formats that can be used into risk systems, and then made available to both to internally to large companies who will take a full copy of the data and run it in their own system because they do not want a security issue of running out in an outside platform, but all the code will be in GitHub, et cetera, so it can be loaded down. And also reporting, we'll have our own front end so that others can come in and directly use the platform. We are not yet working on scenario analysis and stress testing. It's very interesting to our members. We are working on implied temperature rise scenarios and building a model for that. We're working on physical risk right now, how to bring that through, show it in the AI, and how we would supplement it over time. And of particular interest, it relates to Alessandra's comments, is that regulators are very interested in this. Something going on in Europe is that companies will need to share their asset level data to counterparties, to insurers, investors, banks, et cetera, who themselves need to report for regulatory reasons. So part of this platform is to create that public utility to move that data around, make it available to regulators as needed, and maintain it as private data also if needed. So that's the very fast overview of the platform. Many ways to be involved. Basically, you can join, you can be a member, you can. I'll show you the screen there. We can have members, partners, and collaborating in data contributors. Very fast. Glad to talk more in the Q&A.
All right, thank you, Jason. There's a lot to take in there, obviously, but impressive development so far. So homing in on the physical risk side, we'll hear from our third speaker, Julie Pullen, who is Director of Product at Jupiter Intelligence, a startup delivering hyper-local predictions of weather, water, and climate impacts using cloud computing. Julie is also an adjunct research scientist at the Earth Institute at Columbia University. And among the issues she'll address today concern the need and the challenge of linking the physical data on weather and climate risks with data on associated financial claims and liabilities. Julie, please.
Thanks very much, Arthur. It's great to be here with you all. We were thrilled to contribute a foundational data set to open source climate and engaged in a collaboration with the whole open source community. It's really an important initiative that we're really, really happy to be a part of. I'm going to turn my screen and show you a little bit more about what we do at Jupiter. So Jupiter is a startup that's focused on, as you heard from Houston, delivering projections of climate risk, particularly around perils like flooding, heat waves, and other extreme event and long-term change. And this really ultimately enables businesses and other entities to quantify their exposure to climate risk. So these are pivotal foundational data sets that are integrated into the mix in the whole risk management space, as was mentioned earlier, and that critical role that plays in the financial sector. Just a few words more about me. Prior to joining Jupiter several years ago, the company is about 4 years old at this point. I was a professor of engineering. My background is in Earth system modeling and predictability. I have an applied math background in nonlinear dynamics and complex systems. I did a master's in that before pursuing my PhD in oceanography and then a subsequent postdoc in atmospheric sciences. So at Jupiter, we work with customers across all sectors. And we're seeing a lot of interest and customer uptake right now in the financial services industry. So this is of particular interest to us to be talking with you all in this conversation today. We work with a range of different private and public sector entities, and really with the goal of making their businesses and operations more resilient to extreme weather and climate impacts. We've attracted a very dynamic group of high caliber scientists and engineers, and our scientists' expertise span across all the Earth system components and their interaction with the built environment. And we use modern cloud computing. We're a cloud native organization from inception, and modern software engineering for all our workflows. This makes our workflows easily relocatable and transferable. And also helps in our making our product offerings enterprise grade. I wanted to share this because this is some of the use cases that we're seeing in the financial services industry. And really this spans across the buy side and the risk side, and even into some of the more forward-looking institutions creating new products in order to lean away from minimize climate risk and lean toward climate solutions. And this overlaps into the ESG space, and happy to go there also in the conversation afterward. But these are some examples of how avoiding risk and structuring portfolios, specific ways that this type of information plays into decision making in an actionable way. Wanted to cover briefly our commercial product offerings. We use consistent methodology across all the perils, and this provides multiple peril metrics at different timescales and for different scenarios in a probabilistic manner. Because we incorporate flooding sources due to rain, storm surge, and sea level rise, we're able to produce a really comprehensive picture of hazards that a neighborhood or asset faces as well by drilling down to this very, very local level, as you see in this column here. And it's a nice complement to our global product, which provides a coarser resolution look across the really global spectrum of where assets may be located. And again, we do all of this in a scientifically rigorous way. I want to just show you a little bit more to give you a feel for the granularity of some of our commercial offerings. So here's an example of flood risk faced by facilities in the New York area. This is for 2025. So this is the 1% or lower probability event that many businesses fortify to withstand to. And this is for the high sea level rise scenario. And already we should note that our region has experienced a foot of sea level rise and is projected to experience 2.5 feet by 2050. So you see what that looks like, the difference between 2025 and 2050. This is for a facility where there's multiple sites of potential inundation, and you can see the utility and value of being able to differentiate based on the underlying terrain and built infrastructure, what individual buildings and structures on the facility would experience. Here are some resources I wanted to draw your attention to. The Global Association of Risk Professionals has a lovely climate portal with a lot of material around financial risk. They also launched a sustainability and climate risk certificate program. I'm on the advisory committee for that particular certificate. GARP is a nonprofit trade association, and encourage you all to check out some of their materials, including podcasts and webinars at that portal above. Also, we at Jupiter are really dedicated to distributing and sharing the insights that we get from our data sets. You can see some of them listed here. Please go to our website to learn more. Lastly, and most importantly, actually, quantifying climate risk is a significant lever in motivating action on climate change, as Houston mentioned. And it's truly a collective responsibility to ensure a life-supporting planet for our children. So I look forward to the discussion and to continued engagement with the financial community and how we can be helpful with you all. Thank you.
Thank you, Julie, and thank you all three of our panelists for a really, I feel like my head is just vibrating with all the information and all the potential, both the needs and the opportunities here. I'm going to now step back, and we're going to open it up to Q&A. Again, encourage those with questions to post them in the Q&A box in the to the side of the screen. I'm going to start by pulling back and say we're going to focus today on financial stability and the data and climate change and climate risk as a potential risk factor in the stability of the financial system overall. So first, I guess I'm going to ask the panelists in whatever order you feel excited to go. How do you have any thoughts about whether or not climate is a potential factor in the stability of the financial system? So to put some additional context, we think about a financial crisis as being characterized by a sudden revaluation of assets at large scale, such that not only individual firms can be in distress, but those firms in turn create knock-on effects that spread through a contagious fashion throughout the financial system. And when we think about that, it's useful to distinguish between the triggers, some like say Lehman Brothers filing for bankruptcy, and underlying vulnerabilities like for example, in 2008, 2009, an underappreciated problem with the mortgage-backed securities. So do we have a possibility of financial instability, a rapid unraveling of the stability of the financial system that could be traced to to climate risk, or are we looking at things that are going to happen over time, but at a pace that the financial system can keep abreast of, so there would not be any discontinuous shocks? Any thoughts from the panelists on that? Is this a real risk factor for financial stability? Maybe Alessandro, do you have a
yeah, absolutely, Arthur. Let's see if I can share a picture which kind of summarizes what we wrote in our paper, and hopefully that will help. I'll be right with you. The short answer is yes. I think it's at a minimum a risk that's worth exploring. Let's see. Here it is. Let me see if you can see it. And so this is our, can you see it, Arthur?
Yes, yes.
So this is our representation of conceptually what I'd like to reply to your question with. So, oh, this is moved, but I meant to, yeah. So the way that we think about it is that we have the green ones are climate change risks. So physical risk, the risk of, physical damage to property and so forth. Transition risk is the risk that governments change, policymakers change their policies, and so that may result in stranded assets. So, brown technologies and the stock of companies that pollute being negatively affected, and conversely, the disruptors who create new clean energy being at an advantage. And then liability risk is the risk of lawsuits and insurance claims and so forth. And we think that in order to understand the impact on systemic risk, which is kind of the yellow background in this picture, we have to look at put on a risk management hat and apply those yellow bars, which are the criteria that risk managers adopt in assessing risk. So market risk, credit risk, liquidity risk, and operational risk, and I can go into what each of those define. And then you also have to look at market structure and market regulation. So market structure, for instance, has to do with what is the depth of the market, how many market participants, and what market share does each market participant have, and market regulation. So thinking about financial markets, does this financial product need to be traded on an exchange or a clearinghouse, or can it be traded over the counter and so forth? And so we think that this is a useful framework in answering essentially your question, what could be the impact of climate change on systemic stability? And so, just to make an example, we had a study on a default in the Nasdaq Nordic clearinghouse that resulted from a combination of all of these factors. So due to heavy rains in Norway, certain financial products went up instead of down, and due to certain changes in Germany, with respect to the European Union's policy on a cap and trade structure for carbon, we had prices moving the opposite way, and as a result, a single participant in the Nasdaq clearinghouse that had a very, very large portion of the market defaulted, and that default affected the clearinghouse because it resulted in non-defaulting clearing members having to pay up for the default. And this is something that clearinghouses, of course, try to avoid because they're based on this concept of defaulter pays. But when non-defaulting parties, so the ones that didn't do anything wrong, manage their risk properly and so forth, have to pay for someone else's default, that's when there's a problem with the risk management. And so the answer to your question could be that yes, we have to watch this and take this very seriously and gather data and make sure that we adjust our risk management processes so that we can take into account this risk. Now, there are some who say the existing risk management processes are designed to take into account potential future risks. And so we don't need to change our processes and risk management models because we already take into account unforeseeable events to a certain degree. And others who think, no, we need to think about what is specifically different about climate change risks, such as the fact that the past is not a reliable indication of what may happen in the future, and we need to think of new ways to address climate change risk.
Mm-hmm. I mean, I do note that in the example you cite, this is an alarming event, surely especially for those involved, but that the existing risk management systems properly, they worked. And so even though it was a weather-related event that led to a default, it was not, it didn't lead to some propagating risk throughout the financial system. So, but I'm going to note the President's executive order does direct the Treasury Secretary as head of the Financial Stability Oversight Council to engage with the FSOC members to look at, to assess climate-related financial risks to the stability of the U.S. and the federal government, and to facilitate sharing of data and so on. And it also, the executive order directs the Office of Financial Research, which supports the FSOC, to assist the FSOC in assessing and identifying climate-related financial risks to financial stability. And Vice President Quarles was quoted in his testimony to the House Financial Services Committee that yes, this is a serious thing we need to look into. Meanwhile, Larry Summers was quoted saying, there's too much emphasis on this climate stuff. There's other things going on in the world we should be paying more attention to. So I guess I'm hearing, Alessandro, you're basically in the Quarles camp, that this is a serious risk, and therefore we should look at we should have the tools to look into this.
Yeah, I mean, we're in research, so my team and I just kind of
Yeah.
don't pick sides, but it's worth looking into for sure.
Okay. Well, the researchers answer yes. We should do more research. But Houston, do you have any thoughts about
Yeah.
the seriousness of the risk?
Well, I have a sort of a generalized comment, which is things don't change until they do. There's a little bit potentially of a musical chairs situation where, people do not really understand the risk and make decisions until something's really come on them, or so you might say, well, for example, the IEA announcement just a few days ago, last week, about no more need for fossil reserves at all. If you took that and said, okay, if that's absolutely right, which by the way, plenty of people have been saying for a long time, like Carbon Tracker and others, then wouldn't you expect some repricing to happen fairly soon? I mean, if you actually 100% believe that, wouldn't you reprice a bunch of assets, a bunch of companies whose present value is based, at least in part, or maybe large part, on the discounted future value of the reserves or that kind of thing? Has the market repriced that right now? I don't think so. But the question then is, well, when does the prince have no clothes? When does everyone realize, oh yeah, that really is true? So I'm just saying that because that's how a sort of shorter term shock can come from something that is longer term, but it's when people sort of realize, yeah, you know what, this really is happening. I will say, there are many slower things that are very important that will be accommodated over time. So maybe are not sort of the short-term risk. In the real estate area where we are, we're looking at a lot of commitments for net zero emissions from buildings. And we're looking at greater regulations all over Europe now, but also in New York City with Local Law 97 to have some really significant reductions in carbon emissions. These do tend to play out over the next 5 to 10 years. So those can be moderated, even so people aren't paying much attention to them yet in the US. They very much are in Europe.
I think your comment about things not changing until they do reminds me of, I hope I'm quoting it correctly, Stein's law, which states, if something cannot go on forever, it will stop. Now, going on, I want to ask, do we have, if assuming this is a serious enough issue to spend not just this hour, but a lot of other time on the risk of climate and its effects on financial stability, where do we stand? This is the big question. Where do we stand with regard to the data and analytics we need to answer those questions and do that analysis? Are we ready to go? If Secretary Yellen called you up, Julie, and called up Houston, would you say, yeah, we got it, we have everything you need, or would you, what else do we need to do this analysis?
We absolutely stand ready to help. One of the attributes of the open source platform that Houston described is the interoperability of the workflows and the work streams. So that allows people to be able to, contribute their data sets and also, benefit from the economic modeling tools and the physical risk tools like the ones that we've contributed already. So that interoperability is really key as more people come into that ecosystem, and it's all knit together in these ways that the platform is so beautifully designed to do. We'll see the benefit of all of that. These are really powerful tools coming into being now, and we are really, quite frankly, thrilled that this is a priority topic in this administration, and the elevation of non-stationarity, as Alessandro mentioned, as a consideration to feed into the stress testing is really important. Tipping points, I mean, there's examples of how these abound and potential pitfalls associated with tipping points. There's a lot of work suggesting that the housing market is especially vulnerable, but also volatility in pricing. So these are all areas to be investigating. And from a research perspective, Alessandro's point, absolutely, these are really vital topics to be exploring now.
So, but Julie, I'm going to ask, and to you and to Houston, I guess, what I saw the OS climate looks like it's coming along very well in terms of analyzing risks to say an individual portfolio or an individual firm where you have a lot of data, where for cases where you can perhaps supply a lot of data about that portfolio. But is it how does it help us to analyze risk to financial stability overall, or does it, or what more is needed to be built on top of that to answer those kinds of questions? Any thoughts?
Well, I'll take that on a little bit. So yeah, I would say on the one hand, Julie's right. She is standing ready to help. I'll answer your other question a little bit is, are we ready? No, we got to work really fast. We have a lot to do on this platform. And the reason different entities like our members are calling for a platform is that the data isn't organized, but also that regulators really want it. So coming to your point about sort of overall risk, part of that, for example, is the regulatory schemes that are being kind of stood up in Europe, which seek to bring in asset level data so that again these counterparties can understand, okay, what are the risks in my investments and my loans in entities that I insure down to the asset level, so that those can be built into scenarios and modeled properly and that kind of thing. And so that is all in progress, but there's a whole lot to do. The other thing I would say is that there's in the data side that, this is complicated because the many firms like my old firm, MSCI, the ESG group there, that I co-founded and LSEG and S&P and all of these other players now have a fair amount of climate data, and they're charging a lot for it. So is Carbon Disclosure Project. So everyone's that has a sort of a paywall around things. And what we're trying to do is free up at least some of that, figure out the best way to make more and more data freely available so that it can be the basis to make better models and better decisions. And there will be a communal value to all of that. But we have to kind of get over these business model constraints and that kind of thing. So we're not quite there. And to answer the systemic risk, I think that's the goal of the regulators, is to say, okay, let's get this stuff organized, and let's be able to look at the bigger picture through these regulatory schemes to make those assessments that you're talking about.
Mm-hmm. Great. Well, I'm going to move to turn to answer. So we have quite a few questions coming in from the audience. So first on, I believe this is relates to OS Climate. This is from Dick Berner, the former director of the Office of Financial Research, unless there's another Richard Berner running around online. So what standards are you using to define data elements and formats to assure quality?
Very important question, and still nascent. So the way open source projects work is that we have very few resources on the sort of central part of it, and we need to engage members to start building that out. So as we speak, there's a team from Allianz and Amazon AWS, and soon to be helped by Red Hat, working on data governance. So that's a critical part to figure out, well, how do we get data into the commons, and how do we normalize it and make sure, an important part of it is to make sure we know the lineage of the data, be able to see that original data point. Members very much want to not have black boxes. They want to know where data comes from and be able to dig in themselves. They want to see how it's been transformed. So I'd say it's a work in progress, very important question that we absolutely need to address.
Great. Is the OS Climate platform the only one currently available? Are there other main sources of data or other similar sources of analytics?
Well, one of our partners is Amazon and the Amazon Sustainability Data Initiative. So that's a great effort that we're sort of taking advantage of partly to get lots of data sets like NASA data and others that are very useful, but get them onto a cloud environment so they can be much more widely used. And Amazon is hosting that at no cost for the, if the data kind of meets a sustainability criteria that they have. So we will be drawing from data that's there as well. Then there are plenty of other sort of analytical platforms working on these problems. Many of them are proprietary from the entities that I mentioned. So we're not aware of sort of a platform like this for the public. There are many, many NGOs working on various aspects of this, and we are working to bring them together on the platform as well.
Okay. Before I move on, any additional comments or that from Julie or Alessandro on those, or shall I, on those questions so far? No? All right. So Julie's question from Michael Gillette, I hope I pronounced it correctly. Julie's analysis is very detailed. How many SCC registrant companies are currently able to do such an analysis, and more importantly, govern their climate risk management processes to ensure such detail is appropriately addressed? Are there enough subject matter experts on company boards to adequately make sure this happens in the near future? Maybe that's a question for Julie, since reference Julie's analysis. I don't know if anybody happens to know the number of, or some idea of how, I guess the more generally the question is, how, what's the capacity of the larger companies that are, say, registered with the SEC or that, to do anything like this kind of analysis? And
So-
where does the whole system stand?
So we see a lot of companies moving very, very quickly and standing up their capabilities internally to work with data sets like this and working with us in a sustained manner. So I think this is a really active area of development. And in terms of boards, there's a lot of indication that there's strong interest in bringing on people to boards who have expertise in these areas because it is such a systemic risk across all business operations, including supply chain. And this is just an area that is receiving a lot of attention, hence we're here today.
Since you mentioned supply chains, and since I'm thinking about how COVID has kind of done a number on some supply chains, especially with respect to microchips. I wonder, just a question that occurred to me, do you think that a more volatile climate will lead firms to make strategic decisions, for example, to shorten their supply chains or to take other kinds of risk, operational risk management practices? Just, it's an off the top of head question. Any thoughts welcome? Yeah, going once.
Go
ahead, Julie.
Go ahead, Julie.
So it's an important consideration, and they may introduce levels of redundancy into their supply chain, or just at least, coming to grips, grappling with the recognition of where their inputs are coming from and the potential exposures that those have to climate risk, whether it's at the source or in transit. And so I think that we'll see more and more companies trying to get their arms around this and crucially do something about it, take a more active stance in mitigating supply chain risk.
Great. And Houston?
Yeah, I mean, this is an area, I totally believe this will happen, and it's an area where there's more research happening. So for example, S&P, a unit in S&P is a company called Panjiva, which has a really robust supply chain analysis tool. So what I suspect is that S&P and others with similar capabilities will be mapping, physical risk to those supply chains. And there are other ways to do that with Scope 3 emissions. So I believe it absolutely will happen. I think it's still nascent at this stage.
Mm-hmm. So, question from Austin Tuel. I hope I pronounced correctly. One of the recommendations from last fall's Commodity Futures Trading Commission's white paper called for the creation of a climate finance lab at one of the regulators or involving multiple regulators to access climate data and test new products and services in a type of safe harbor environment, similar to how has been done for fintech sandboxes and tech sprints, et cetera. Do you think this type of approach is realistically on the horizon? And maybe I'll ask, I'll add on to the question. Do you think that not whether or not it's realistic? Do you think it should be realistic? Do you think that's a good approach? And maybe I don't know if Alessandro, you have any thought about that from inside the Fed system.
Yeah, I mean, again, speaking as a researcher, so I guess an inside observer, if you will. I'm not privy.
You're not making policy on the fly with us. I understand.
But I think that the executive order is a strong indication of the fact that, at least according to the executive order, in a way, if you read between the lines, that's what the FSOC, the role of FSOC could be, or definitely should be with respect to the report. And so there was also an FSOC open meeting recently before the executive order where the Federal Reserve Board made a presentation, and then each agency kind of walked through what they are doing with respect to climate change risks. So, I think that coordination among the many regulatory agencies would be welcome, would be useful. And it seems to me that that the executive order is looking to nudge in that direction.
Great. Well, actually, and Dick Berner notes that the CFTC recently launched a climate risk unit that is designed to meet the need in the climate report. So you didn't need to make policy in real time, but maybe you inspired it. So there's a question. Do you think the SEC should mandate the disclosure of climate risks for companies? Is this useful and doable?
So, of course, the SEC will determine what it makes most sense for the SEC to do. I guess I note that, so there was this interpretive note guidance from 2010, which, as I noted, is over a decade ago, and there's this new renewed interest from the SEC. So I think rather than thinking about in terms of what the SEC should do, I would kind of observe the fact that the SEC seems to be already doing something about it, and so we'll kind of watch this space to see what happens next at the SEC. But sometimes I think about 10b-5 disclosures and how seriously they're taken in in the investment community and by the lawyers who write 10b-5 opinions and so forth. And I kind of wonder with the SEC, and again, I'm not saying what they should do, but what they might do. The way that climate change disclosures are right now is very different from other types of disclosures, and so and that's been noted by the CFTC report as well. So what next steps will come out of the SEC will be very important to determine the level of investment that will be required by companies. And so it kind of links a little bit to the question that was posed to Julie. And I think about, so in my mind, I think of observing on one hand what happens in the voluntary markets and what happens as a result of policymakers taking certain decisions. So for instance, even in the context of carbon pricing and trading carbon credits, there's a very large effort, a task force on voluntary scaling of carbon markets, which has received a lot of attention. And I think that the evaluation needs to be made of, what are the efforts on a voluntary basis versus how do the compliance markets work? And I realize we could have a whole session on that topic, so I'll stop there.
Yeah. So we are just about at the end of the hour. I'm going to give each of the panelists, we are at the end of the hour. I hope you can stay on, because if you can't, I understand. But I have one last question for each of you. What is the biggest need right now for understanding climate risks to the financial system? Is there one pain point or one thing that we should be most doing in order to enhance our capabilities? And maybe you might think, well, yes, and I'm already doing that. I just told you about that. But if there's just generally one thing, maybe I'll go in reverse order of the speakers. So I'll ask Julie to go first.
I'm going to go with creating community around these topics. So having these conversations and having coordinated action, I think, is absolutely vital. And to the extent that all of us as individuals and collectively in organizations can support this in order to quantify and ultimately mitigate the risk, we will have a more stable and resilient society.
Good, thank you. And Houston?
Yeah, well, we're really focused on data. So I would say consistent, freely available carbon emissions data. There's a lot of it, but it's not consistent and not all fully available. But the same is true about many aspects of the data. So a robust, confident layer of data that we can all work with and then build tools and analytics on top of that.
Great. And Alessandro?
I'm tempted to say more research, but instead I'll say accurate, reliable data.
Excellent. Okay, well, this has been, for me, very stimulating. I expect for the audience as well. Really want to thank all three of our panelists, Alessandra Coco, Houston Baltzell, and Julie Pullen. And I want to thank the Center for Financial Policy at the Smith School at University of Maryland for hosting this event. And thank everyone for coming. And please do stay engaged and watch this space. There's a lot more clearly going to be coming soon. All right. Thank you all.
Thank you.
Thank you.